Hey everyone, welcome back. Today we're going to do a deep dive on three specific ETFs, and we're going to see if they actually live up to the hype for passive income.
Okay.
We're looking at this article titled, Why I'm Loading Up on These Three High Dividend ETFs for Passive Income.
All right.
So, what do you think about these ETFs? We've got the JPMorgan Nasdaq Equity Premium ETF, that's JEPQ, the SPDR Portfolio High Yield Bond ETF, as SPHY, and the iShares Core U.S. Aggregate Bond ETF.
AGG.
AGG, yeah.
It's really interesting that these three were grouped together because they each have such a different approach to trying to get that passive income.
Yeah, and that's what kind of caught my eye, too. We've got one that's playing the options game to get bigger yields, and then we've got one that's going into high-yield bonds for, more yield, but, with more risk.
Right.
And then the third one's just kind of like steady, reliable income.
Right.
So should we jump into that first one, the use options to get the higher yields, JEPQ? Okay, so what JEPQ does is it sells these out-of-the-money call options on the Nasdaq 100 every month. And it uses that to generate the income for investors.
Mm-hmm.
So it's almost like they're collecting premiums for providing insurance. So if the market swings up really high, they might miss out on some of that gain, but they still get to keep the premiums that they've collected.
Okay, so it's like they're betting that the market's not going to go up too high.
Right.
But they're getting that steady income.
Yeah. That's right.
Okay, so in the article, it was highlighting that they've had a pretty impressive dividend yield recently, like 9.5% over the past year.
Right.
Which is much higher than what you would get with like a high yield bond, which is around 7.9%.
Yeah.
Or the 10-year treasury bond, which is at 4.4%.
That's right.
Now, I know you'd mentioned that you're looking for that consistent income to reinvest. So is this something that's appealing to you?
Yeah, it could be. But it is important to remember that those premiums that they get are really influenced by how volatile the market is. So if the market is kind of flat and nothing's happening, those premiums are going to be lower.
Mm-hmm.
But when things start getting a little rocky and volatile, those premiums go up. So your income stream, it's not going to be perfectly consistent every month.
So it's not completely hands-off.
No.
Got it.
It is something that you need to pay attention to.
Okay, but what I thought was interesting is this ETF also holds stocks.
Right.
So it's not just relying on the premiums from the options for its returns.
You can see some price appreciation if the underlying portfolio does well.
Okay.
So it offers you kind of like a two-for-one punch if you're looking for both growth and income.
Okay, cool. So we've got this JEPQ using options. Let's move on to that SPDR Portfolio High Yield Bond ETF. That's SPHY.
Okay.
Now, I know you mentioned that you're okay with a little bit of risk if it means you can get some potentially higher returns. Would you say that SPHY kind of falls into that category?
Definitely. SPHY is focused on those high-yield bonds, which come with higher risk. Because the companies that are issuing them, they're not as financially stable, so it's a trade-off. You get higher potential returns, but you are taking on more risk.
Got it.
The nice thing about SPHY is that it mitigates some of that risk with diversification.
Yeah, that's what was interesting to me in the article. They really highlighted that SPHY was doing this diversification. Can you kind of unpack that for us?
Absolutely.
Yeah.
So SPHY, it doesn't just put all of its eggs into one basket. It holds over 1,900 bonds.
Wow.
And they're across all these different sectors and issuers and maturities. So if one of those companies have a little trouble, maybe they default on their debt.
Right.
It's not that big of a deal for the overall portfolio because they've diversified so much.
It's like a safety net
Yeah.
within a riskier class. Okay.
That's right.
That's it. That makes sense. And they did say in the article it's got a distribution yield above 7%.
Yes.
Which isn't too bad compared to the other options we were just talking about.
No, it's not bad.
Yeah.
But again, it's important to remember that with higher return always comes higher risk.
Okay, so we've got JEPQ that's using options. We've got SPHY that's venturing into those high-yield bonds. For our final ETF today, let's talk about something a bit more maybe grounded.
Yeah.
The iShares Core U.S. Aggregate Bond ETF, the AGG.
Yes.
Would you say that's a more conservative choice?
Yeah, I'd say AGG is definitely the more conservative choice of the three that we've talked about today. It focuses on investment-grade bonds, which means that they are considered to have a lower risk of default, and they're really designed to provide that steady income with less volatility.
Okay, so when we say investment-grade bonds, what does that really mean? What's making up this ETF?
So AGG, it's built on a really strong foundation of U.S. government-backed debt. So almost 70% of its holdings are in things like treasuries and mortgage-backed securities, and then the rest is made up of bonds from industrial, financial, and utility companies.
So it's basically like investing in the stability of the U.S. government.
Right.
I can see why that would be appealing to people looking for that low risk.
But remember, low risk generally means lower reward. AGG's average yield over the past year has only been 3.6%, which is lower than both JEPQ and SPHY.
Right.
But it does give you that level of stability and that peace of mind that maybe those other two don't.
Well, and speaking of peace of mind, the article did mention that AGG's yield has been going up recently.
Right.
Reached 4.3% last month. Why is that?
Well, as those older bonds within the ETF mature, and they're being replaced by bonds issued at the current higher interest rates,
right,
that naturally lifts the overall yield of the entire ETF over time.
Oh, so it's kind of like getting a bonus for being patient? I like that. Okay, so we have JEPQ going for those potentially high yields with options.
Right.
SPHY venturing into higher risk, higher reward territory with those high yield bonds.
Yeah.
And then AGG playing it safe with those investment grade bonds. That's a pretty diverse set of options.
And that's what makes it so interesting. We're looking at three completely different approaches to passive income generation.
Yeah.
But it all comes back to you and what you are looking for. What are your goals? What is your risk tolerance?
Well, you mentioned that you're looking for that consistent income to reinvest, and you are also open to a little bit of risk if it meant higher returns based on what we've talked about so far. Is there anything that's kind of jumping out to you as maybe a good fit for your needs?
Yeah, it is making me think, JEPQ, that yield is really attractive, but that fluctuating income stream, that does give me pause.
Right.
SPHY, that diversification strategy seems pretty good, but I would want to look into it a little bit more. See what specific sectors and holdings they have just to understand that risk profile a little bit better.
Yeah.
And then AGG, the stability is appealing, but I do wonder if the yield is going to be enough to meet my long-term goals.
I see where you're coming from. There's definitely a lot to consider here, and it's not just about chasing the highest yield, right?
Right.
It's about understanding the strategies, understanding the risks, and how it fits within your broader goals.
Exactly. And what's fascinating to me is that even within one article, we're seeing the complexity of building a portfolio for passive income.
Yeah.
There's so many different things that you have to consider.
Right. And that's why we're here to unpack it all, right?
Right.
So let's take a deeper look at each of these ETFs in turn.
Right.
Why don't we start with JEPQ and that option strategy? I'm curious to understand how it works in practice.
Yeah, let's dive into the mechanics of those options and see how they're leveraging that to generate that income.
Sounds good. Let's do it.
All right. Okay, so let's dive a little deeper into that option strategy that JPQ is using. I know you mentioned you were curious about how it works in practice.
Yeah, options have always seemed a bit like a black box to me. Intriguing, but also kind of intimidating.
I understand. But the core concept behind what JPQ is doing with these options, it's not overly complex. Let's imagine for a second that you own like a rare collectible comic book.
Okay.
And you decide you're going to sell somebody the option to buy that comic book from you.
Okay.
A set price 6 months from now. So they'll pay you a premium for that option, regardless of whether they actually decide to buy that comic book when the time comes.
So even if they never buy the comic book, I still get to keep that payment.
Yes, exactly.
Like I'm renting out the possibility of selling it.
Yeah, that's a good way to think about it. And that's the basic idea behind these covered call options, which is what JEPQ is using. They already own the underlying assets. In this case, it's a basket of those Nasdaq 100 stocks, and they're selling someone else the right to buy those stocks at a specific price in the future.
Okay, so if the market kind of stays flat or goes down, JPQ just pockets the premiums and keeps the stocks.
That's right. Those options are likely to expire worthless in that scenario, meaning that the buyer wouldn't actually exercise their right to buy those stocks.
Okay.
But what if those Nasdaq 100 stocks, they surge way above the agreed upon price?
Then it seems like the buyer would definitely exercise that option, and JPQ would miss out on some of those gains, right?
Yeah, you're right. They would have to sell those stocks at that predetermined price, even though they could have gotten a higher price on the open market. But remember, they still keep all those premiums they collected up front.
Right.
And any profit from the price appreciation up to that set price.
So there's like a trade-off, right?
Yeah.
They're limited how much they could potentially gain on those stocks.
Right.
In exchange for that steady income from the premiums.
Exactly. It's a strategy that prioritizes generated income over maximizing potential capital appreciation.
So if your main goal is consistent income, JEPQ's approach makes a lot of sense.
It could.
But if you're more focused on trying to grow your investments really aggressively and you're not so worried about the regular income, it might not be the best fit.
You got it. It always comes back to aligning your investment choices with your goals and your risk tolerance.
Okay, so let's switch gears a little bit. Let's talk about SPHY and those high-yield bonds. We touched on this a little bit before, but it holds over 1,900 different bonds, which seems like a pretty impressive level of diversification.
Yes, diversification is really important when you're dealing with the high-yield bond market because you're dealing with companies that have a higher risk of default. So if you spread out your investments across a bunch of different issuers, sectors, and maturities, it helps to minimize the impact if one or even a few of those bonds don't do so well.
It's like you're creating a buffer against potential losses.
Right.
What happens if interest rates suddenly go way up?
That's a good question.
How would that affect SPHY and the income it generates?
So generally when interest rates rise, the value of existing bonds tends to fall because all those new bonds are being issued with higher interest rates, which makes those older bonds less attractive to investors. Makes sense, right?
Yeah, it does.
Yeah.
So if rates were to shoot up suddenly, could that lead to a decline in SPHY's value and maybe even impact those distribution payments that go out to investors?
Yes, that is a possibility. And it highlights the fact that even with all that diversification, high-yield bonds are still subject to, market forces and fluctuations in interest rates. It's definitely something to be mindful of, especially if you're relying on that income stream for living expenses or to reach some other financial goal.
Yeah, that makes sense. Okay, for our final ETF today, let's talk about AGG. You've described it as a more conservative option, kind of built on that foundation of U.S. government-backed debt. Can you talk a little bit more about why those types of bonds are considered to be lower risk?
Yeah. So the U.S. government has never defaulted on its debt, and it has the ability to print more money if it needs to in order to meet its financial obligations. So it's seen as a really safe bet by global investors.
So basically, investing in those U.S. Treasury bonds is as close as you can get to a risk-free investment.
It's about as close as you can get, especially in the world of bonds. Now, of course, no investment is completely risk-free, but U.S. government-backed debt, it's generally considered to be extremely safe.
That makes sense. Now, AGG's holdings aren't only limited to those government bonds, though, right?
That's right.
It's got bonds from other sectors, like industrials and utility.
Exactly. So the majority of AG's portfolio is made up of that U.S. government-backed debt. But they do also have a smaller allocation to bonds issued by corporations in those other sectors that you mentioned.
Okay, so it's not entirely government bonds. It's a mix of different types of investment-grade bonds, all with the focus on generating that steady income with low volatility.
Yeah, it's a good example of how an ETF can provide you with both diversification and that specific investment strategy within one fund.
Okay, we were talking about how AGG's yield has been going up recently,
right,
and reached 4.3% last month. What would you say has driven that?
So as those older bonds within the ETF, they mature, they're being replaced with newer bonds that are issued at the current higher interest rates. And so that naturally just increases the overall yield of the ETF as time goes on.
So AG is actually benefiting from this rising interest rate environment.
Exactly. It's a good reminder that even investments that seem really stable can be affected by those broader economic factors.
Okay, I'm starting to see how each of these ETFs kind of has its own strengths and weaknesses. JEPQ offers those potentially higher yields, but it has that fluctuating income stream.
Right.
SPHY is venturing into that higher risk, higher reward territory with those high yield bonds.
Right.
But diversification helps to kind of balance out some of that risk.
Yeah.
And then we have AGG providing that stability and consistent income, but maybe at the cost of those lower overall returns.
Right. And that brings us to the million-dollar question for you. Which one of these ETFs aligns best with what you're looking for in a passive income investment? You've covered a lot of ground so far. Do you have any initial thoughts, or are you leaning towards one or the other at this point?
You know, you've really laid out all the pros and cons of each ETF, and it's definitely got me thinking a lot about all this. Now let's take a step back and look at the bigger picture. How do these ETFs like the JEPQ, the SPHY, and the AGG, how do they fit into a well-rounded, diversified investment portfolio?
Yeah, that's the question, isn't it? It's not just about picking one of these and calling it a day. You need to think about how they're going to play with the other investments that you might have.
Right.
So, imagine your portfolio. It's like a well-balanced meal.
Okay, I like that. So we don't just want a plate full of high-yield bonds.
No, exactly. You want to mix all the different food groups, right? You got your proteins, your carbs, vegetables to make sure you're getting all the nutrients you need. And in the investment world, those different food groups could be your stocks, for growth, potential bonds for stability, real estate for tangible assets, and then maybe a little dash of alternative investments just for a little extra flavor.
So where do these passive income ETFs that we've been talking about, where do they fit into that balanced meal analogy?
Okay, so let's start with JEPQ. It's kind of like a flavorful, but maybe a little spicy dish.
Okay.
Because that option strategy that it uses, it can get you those higher yields, but it also comes with that added risk. So it might make sense to have it be like a portion of your portfolio that's dedicated to boosting your income, but it shouldn't be the main course.
So it's a side dish to add a little something extra, but you don't want to fill up on it.
Right, exactly.
Yeah.
Now, SPHY with those high-yield bonds, it's kind of like that protein-packed steak.
Yeah.
You know, it can be really satisfying, but it's also a little heavier on the risk side.
Right.
So it could fit well in a portion of your portfolio where you're looking for those higher returns. But again, you don't want it to be the only thing that you're eating.
Moderation is key, especially with those riskier investments.
Exactly. And then finally, we got AGG, which I kind of see as the vegetables in our well-balanced meal.
Okay.
It might not be the most exciting part of the meal, but it provides those essential nutrients.
Yeah.
You know, in this case, stability and consistent income. And that helps to ground the whole portfolio.
It's the foundation that keeps everything else steady, even when those riskier assets get a little shaky.
Yeah.
Exactly. So in a perfect world, you know, your plate's going to have a little bit of everything in portions that make sense for you and your own needs.
Right. And just like a good nutritionist can help you create a personalized meal plan, a financial advisor can help you figure out the right mix of assets for you.
Exactly.
Including these passive income ETFs that we've been talking about, so that you can build a portfolio that aligns with your goals and your risk tolerance.
Yeah.
Now, you mentioned earlier you were comfortable with a little bit of risk.
Yeah.
You're looking for that consistent income to reinvest. Has this deep dive at all changed your thinking on how you might use these ETFs to reach your long-term goals?
It definitely has. I think at first I was really drawn to those higher yields from JEPQ and SPHY.
Yeah.
But this whole conversation has really made me appreciate the importance of that balance and that stability. I think I'm leaning more towards a combination of those higher yield options with something like AGG to give me that good solid base. That sounds like a really smart approach. You know, it's all about finding that right balance between the risk and the reward.
Yeah.
And making sure all your investments are working together to help you reach those goals.
It's a journey, not a destination.
Right.
You know, your needs and your circumstances are going to change as time goes on, and your portfolio, it should adapt along with those.
It's like adjusting your diet as you get older.
Exactly.
Your metabolism changes and you need more of one thing and less of something else to stay healthy.
Right. Regularly reviewing your portfolio and making adjustments as you need is really important for success over the long term.
This has been a really great deep dive.
Yeah, it has.
We've gone into the details of 3 different passive income ETFs, JEPQ with its option strategy, SPHY focusing on those high-yield bonds, and then AGG with its stability and investment-grade bonds.
And we saw how each one can play a different role in a diversified portfolio, just like the ingredients in that well-balanced meal.
Before we wrap up, I want to leave our listeners with one final thought. As you're exploring these ETFs and other investment opportunities, you know, knowledge is really power.
Right.
The more you understand about the different strategies and the risks and the potential rewards, the better you're going to be at making those informed decisions that align with your financial goals.
And don't be afraid to reach out and get some advice from financial professionals who can really help you navigate through all the complexities of the market and create a plan for you to achieve your financial aspirations.
Well, thank you for joining us on this deep dive. We hope you found it informative and empowering. Happy investing, everyone.